we begin with a look at the overall market and stocks and really the economy, because there is some, not a lot, but some cautious optimism starting to trickle out around both the markets, because they ended their day and they ended their week higher as well. Perhaps some hope on the horizon about America getting healthy and getting working again. But Tim Seymour, with 22 million filing for jobless benefits in just the last 3 weeks, wiping out a decade of job gains, and no doubt some very hard economic times for millions of people still to come, is there really any good reason, maybe it's the Fed, for markets to be rising like they have been?
Well, I think it's a liquidity squeeze. It's been a skepticism trade that has really squeezed markets higher. It has been a combination of a Federal Reserve expanding its balance sheet to $6.1 trillion. It's been some fiscal policy that clearly is shown to be focused on small business. It's been all of this well ahead of the recession, frankly. And it's been a dynamic where I think the positioning of markets allowed markets to push on higher. It doesn't change from where we are, but obviously we started all this on COVID-19. And as we've gotten more clarity on COVID-19, not only in terms of the progression, the peak, the apex, the curve, but also as the rest of the world begins to open their markets. And we do have a couple weeks of data points coming out of Asia, most notably China. We had PMIs, we had import-export data this week that largely came in significantly better in China than expected. We talked a lot about Apple earlier in the show, but again, those smartphone shipment numbers. So what does it look like for markets on the other side? That's what happened this week. That's what happened last week. But to say that, at 2,850 to 2,900 on the S&P, you haven't seen an enormous run that is something to be wary about, is to misjudge here. I don't see how equities have to get away from us, but I do think that the confluence of events here has taken us.
Victoria, let's talk about the macro markets before we start to get micro, because I ran the numbers before the show, and when you look at the S&P 500, 112 members of the S&P 500 are higher year over year. So in the past 12 months, basically we'll call it 1/5 of the market is still up. We're facing the greatest global pandemic in at least the last 50, if not 100 years. The consumer economy is completely shut down, and yet a lot of stocks are still outperforming. Can you please help us, help me make sense of what's going on?
Well, Brian, I'm not sure that was the case if you look back to when we hit those lows on March 23rd. I mean, we have come back about 30% from that point in time. And you do have certain sectors, certain companies that are going to benefit from the situation that we're in now. Obviously, Procter & Gamble gave really good earnings numbers, and you saw that they had sales moving higher, that pantry stocking that's going on. You've got other companies, tech companies, that are going to benefit from what we're doing. So it's not surprising that you have a handful of companies that are driving the market higher. But across the board, we have come back quite a bit from those lows. I think the market said maybe 2,200 was too low, but 3,400 was too high. So it's trying to find somewhere in the middle, and that's a little bit higher than where we were a year ago. But a lot of this that we saw today was purely on the optimism for the economy reopening and on the Gilead news. And I think some of that might be given back next week.
You think so? Okay, Guy Adami. I mean, listen, we've got Elliott Management out this week saying we could go 50% from our highs. Scott Miner's been out there saying this. We've got some optimism. I get it. I understand where that's coming from. But at the same time, there's been a huge pile into basically the same names, for lack of a better way to say it, I guess, in these markets. Is there more risk to the upside or to the downside?
Well, Tim's pointed that out, that the pain trade is higher, and he's been spot on with that. And today is a great illustration. People ask all the time, the difference between the real economy and the stock market. Well, if you want like a thesis or a paper on it, just look at what's happened over the last couple of weeks. Data that's probably the worst we've seen in a century, overlaid with a stock market that, to the earlier guest point, it's going up 30% from that March 23rd low. I mean, people have to be scratching their head, because I know I am. To me, it comes down to this. At current levels in the S&P, if you assume we're going to get $130 worth of S&P 500 earnings, and I got to tell you something, that's a stretch. Right now, the S&P is trading at 22 times, which is very rich. Now, the counter is the Fed's buying everything, and there's so much liquidity in the system that none of that matters. If that's the case, we're going down the same rabbit hole we went down for the last decade. And it just sets us up, I think, in the long term for just more pain ahead.
And that's Mike Khouw. I think Guy nailed it. Listen, you get people, I hear the criticisms and I get it. The stock market's going up while 22 million people are filing for jobless benefits. It makes no sense. But when you look at a Fed that has thrown $5, $6, $7, maybe $10 trillion with leverage from the Treasury at the problem, and you just think, don't fight the Fed, is there any reason to go against the Fed and the 2-week trend here?
Well, I mean, obviously, strong monetary policies to try to bolster the market are going to have an impact. The fiscal policies that we're seeing and may see will also have an impact. But I think people ought to be asking themselves this question, which is, while we have these winners like Amazon, we have winners like Procter & Gamble, we have other stocks that have held up very well like Home Depot. The question that you might ask yourself is, we obviously have a very bad economic situation. It's obviously hurting businesses very badly. We hear it all the time, and it's going to continue to. Those are not the only companies in the market. And how much higher can they go? So if the best performing stocks have already given us what they're going to do, and the bad news is still going to continue to trickle in, then to me, the risk is necessarily on the downside as people begin to digest that. And we're just at the beginning of that now. We're coming into earnings season. And I think that this is probably both the most important earnings season and the least relevant earnings season because you're looking back rather than forward. The reason it's important is because everyone's going to be on every conference call saying, okay, what are you doing? What is going on? How does it look? How much risk is there? We don't still know exactly how much there is. And for some cases, you might have 4 to 6 weeks worth of complete runway and it's not a big thing. When you start to extend that, if we extend it, then those businesses are going to face additional risk, and then you have to really worry about what equities are going to do.
I think that is extremely well said, Mike. Most important, but least relevant. It's very nuanced. We're going to get back to all you guys, but let's continue on that path because we got to remember, folks, that every week that we get through each week is 1 week closer to maybe coming out of the other side of this scary moment in history. But time doesn't stop for corporate America, and they are still churning out their quarterly numbers. And a flurry of big companies are set to report their numbers and maybe, perhaps, give us some guidance on what they see ahead. But I guess here's the big thing with earnings. The number of companies withdrawing guidance continues to grow. So that's got many asking, including Bob Pisani, should companies simply ditch guidance? Bob, it's a very good, very relevant, very important question right now.
It's been around a long time, but with all of these companies all of a sudden coming out, Brian, declining to provide earnings guidance, look what we've got here in the last 24 hours. Uber, Abbott, Conoco, Phillips, Jack in the Box, GoPro, Bed Bath & Beyond, Audi, Volkswagen over in Europe. The list is really long of these companies declining. So this has been around for a long while, but there's a renewed debate. A lot of people coming out saying, let's just kill it all together. Let's kill earnings guidance in general. It's outdated. The argument against it is pretty simple here. The people who don't want it say it's too much focus on short term. It increases the volatility of stocks needlessly. It's linked to lower earnings growth in general. And a lot of investors don't want it. They want long-term guidance, meaning once a year. That's the argument. Now, remember, this has been around a long time. Remember 2 years ago, Brian, Jamie Dimon and Warren Buffett came on Squawk Box, and they argued the exact same thing. They basically said we should finally just dump the whole argument and move on and just provide guidance on a yearly basis. I'll tell you why I'm not so enamored with this idea. Number one, only 1 in 5 companies actually provide earnings guidance. We emphasize those that do, so it looks like there's more than there really is. Number two, remember, companies still have to file their quarterly earnings reports. It doesn't eliminate that. You have to do that legally. And if Wall Street doesn't provide if the companies don't provide guidance, Wall Street's going to provide guidance. Their analysts are going to go out there and say, here's what we think is going on. And that means less commentary available to the general public. And Wall Street is going to step into that vacuum. Finally, Brian, here's a thought. How about, if you want to deal with short-termism, how about having CEOs stick around a little longer? The average CEO only lasts 5 years these days. And how do they get paid? Well, their compensation is largely based on whether they can get the stock price up. There's a short-termism if you want to deal with it. I'd rather see that addressed than telling companies they shouldn't be providing any kind of earnings guidance. Brian?
Well said. Bob Pisani fired up on a Friday. Bob, we appreciate it. Have a great weekend to you and yours, and we'll see you next week on the other side. Victoria Fernandez, what do you think? I mean, do you want to hear companies, the CEOs of the companies that you own for your clients, do you want to hear them give some kind of guidance and then get it wrong, or simply say, we have no idea, we're withdrawing guidance? What's better for you?
I don't think investors want to see companies just throw in the towel, throw their hands up and say, we don't know what's going to happen. They need some type of guidance. Now, maybe you don't give specific numbers. Maybe you give a broader range than what you have before, or at least give me some kind of a scenario. Give me a worst case scenario or a best case scenario or some type of information that lets me know what's coming. I understand it makes people focus on the short term. The guidance could be a little bit longer looking if we want that to happen, extrapolate it out over a longer period of time. But I think companies need to provide something. Otherwise, it's going to be left up to the investors and whatever they can create in their own minds as to what they think is going to happen. I think that would cause more volatility in the markets.
Yeah, maybe I can see that, Victoria, but Tim Seymour, I mean, if they give you a little but get it spectacularly wrong, that's a risk too.
Right. Yeah, and I think they're concerned about that. First of all, everybody gets a mulligan on this quarter, and I think it would be potentially, it would not necessarily help investors to get some of the insights that CEOs are seeing right now in the short term because they have no idea. So I do think overall guidance as a function on a quarterly basis. I believe in as much transparency as possible. I believe in Reg FD. I believe in the things that have also some of the rigging of markets out of it. I think CEOs and CFOs, when they're delivering corporate numbers, they can decide what metrics they want us to listen to, but I think they need to give us something. And think of Apple, right? Apple, who I think we would hold a very, very high bar to as it relates to corporate governance. Also kind of, what was it, a year ago, they gave us some sense that they didn't want to give iPhone shipment numbers, and the market was a little disappointed at that. And Apple, which gets a corporate governance premium, suffered at that time, whether they should have or not. So again, the market is a discounting factor, and information or lack thereof. Corporate governance is a scoring system, and I think it will feed into how companies are valued. If companies don't want to be transparent, I think they will trade at a discount, and I think that's something else to think about.
I'm still thinking about what Mike Coe said. So, Mike, I'm just going to go back and ask you, what did you mean by most important but least relevant? I thought I sort of understood it. Now I'm thinking more about it. It's been a long week. I'm thinking maybe I didn't fully. Why is it not relevant?
Well, obviously, one of the things about earnings reports is they're telling you what has happened, and what we're going to be dealing with is, what's behind us now. And I think what most people are really interested in is what's going to be happening going forward. And I have a feeling that a lot of the questions that are going to happen on conference calls are really going to be trying to dissect what happened at the tail end of the quarter ending at the end of March, obviously, because that's when we began to see the impact of that. That's going to be the best tell to the degree that we can get any transparency on that transition from an open economy to a closed one. That's going to be the best lens looking forward as to what's going to happen. So you're going to be looking at a number that has nothing to do with the quarter you're in, but there's a little piece of it that might give you a clue. And this actually relates to what Bob and everybody else is talking about here. Obviously, investors want as much transparency as they can have, as often as they can have it. And of course, we recognize the fact that management doesn't always know with a great deal of precision, and they're not obligated to tell us in any case. But the fact of the matter is that if you invested in any business, in anything, you would want to get financial information provided to you as much as you could get, as soon as you could get it. So to the degree that they can offer guidance, even if it's wide, that's really, really helpful.
Yeah, good stuff there. And I learned something as well from Bob Pisani. I did not know that only about 20% of companies provide any kind of guidance as well.